Greetings. That music can only mean one thing. It's time for Cup of Joe. I am Mike Carrazzo, your host, and it's November already, and getting near the end of the year, and we got some exciting stuff in plan for this episode of Cup of Joe. I got a special guest with us, Joseph T. Ryerson, behind my right shoulder there, but we're going to be joined actually by a real special guest, Chris Aiello with FreeForm Technologies. We're going to be talking a little bit of additive manufacturing. But before we do that, I got to turn it over to the man of the hour, Nick Webb. Nick, good afternoon.
Good afternoon, Mike. How you doing today?
I'm doing well.
Excellent.
And had a bit of a scare. You almost got your hair cut over the weekend, right?
Well, yeah, I mean, for those who don't know, I was a little afraid I was going to have to be flying Chris into town because for those who don't know, Chris is actually a Penn State alum, and we had a bit of a tight scare this weekend. It wasn't until the fourth quarter that they finally pulled it out. But yeah, I was afraid we were going to have to fly him in. He was going to be shaving my head live on Cup of Joe, which would have been a great show.
Yeah.
Fun.
Well, before we kick into it, as always, I'm going to note that there's the Q&A button there in the lower portion of your screen. Send in a question. We're going to do our best to answer it live. If not, we will do our best to get to it following the show. And as always, this episode will be available on Ryerson's YouTube channel beginning by tomorrow, if not by Monday. And just a quick reminder, we did Metal 101 a few weeks back. Hopefully many of you joined us for that. And that full recording is on our YouTube channel as well. So if you didn't see that live, check out the recording. Some really good stuff there. So Metal 101 is kind of the intro course, and on to the master's class, which I call it, is Cup of Joe. So Nick, take it over.
Awesome. Appreciate it, Mike. Yeah, really excited for today's show. We've got Chris Aiello from FreeForm Technologies, which for those who don't know, we Ryerson made an investment in FreeForm Technologies. They are not technically a Ryerson business as of this stage, but we are certainly working in tandem with them. So we want to make sure that is disclosed. But they are doing what's called additive manufacturing. Some of you might know it as maybe along the lines of like 3D printing with regards to metals. But really excited about it because I know very little about the space. So I expect we're going to learn a fair amount about a pretty new, innovative technology that's coming down the pipeline. And Chris is certainly one of the experts in that field. Without further ado, though, as always, we do have to give our safe harbor provision. These are the opinions of Nick Webb, Mike Carrazzo, Chris Aiello. Do your own research. We're going to provide you with the best information that we've got at our fingertips, but it is certainly not investment advice. But we're going to hopefully have a nice little show for you. With that being said, I am going to kick it over to Chris Aiello, who's in charge of sales and business development within FreeForm Technologies. Again, FreeForm Technologies is basically doing 3D manufacturing, additive manufacturing within the metal space. But that's about the extent of my knowledge within that world. So I'm going to kick it over to the real expert. Chris, go ahead and take it away.
Sure. Thanks, Nick. So FreeForm Technologies, we offer a service called metal binder jet additive manufacturing. And this technology, we take a 3D model and then we build it up layer by layer in order to manufacture the part. This technology really works no differently than the printer in the office works, except for our paper is metal powder and our ink is binder that's holding the part together. So we spread powder across the build platform. We deposit ink on that powder to bond each particle together. And we do that layer by layer by layer to manufacture the part. After we go through that step, we go through a curing cycle, which hardens the binder, and then a high temperature sintering operation, which actually consolidates those metal powders to make a wrought-like metal part. When people talk about metal binder jet additive manufacturing, they most commonly compare it to metal injection molding. So I put together a little chart here to kind of show the differences and the benefits of both. Metal injection molding is also a service that FreeForm offers. When it comes to binder jet, the volumes are on the lower side. I put in here 100 to 25,000 parts annually. A lot of times that's dependent on the customer. If the customer doesn't want to capitalize tooling or amortize tooling, they can go higher. We have some parts that are higher in volume than that. And then metal injection molding is 25,000 or 50,000 parts a month sometimes. You get into some really high volume, automotive applications for that type of technology. One of the major benefits of metal binder jet is tool costs. Sometimes it can be zero. You can just buy parts from the technology. There's no upfront cost. There's no upfront waiting time. We can manufacture parts right away. Sometimes there's tolerances that we can't hit, so we'll add a CNC operation or some other secondary operation, and there may be fixture costs involved with that. A metal injection molding tool can be $30,000 or more. That technology is using standard plastic injection mold tooling. So if people are familiar with that technology, our tooling for MIM works the same way as plastic injection molding tooling. Lead time is the other major benefit of additive manufacturing. You can get parts in days instead of waiting weeks for tools to be done or months before you see the first part. This is a big benefit because it also gives you the ability to iterate process or iterate design before you walk in and build a hard tool. So if you're on the fence or you don't know form, fit, or function, you're able to buy parts or several different iterations of a part and make sure it fits into the assembly or to the end use before hard tooling a product that you're going to spend $50,000 on. That can be a big benefit.
So Chris, just interrupting right there. If we've got customers on the line or maybe salespeople on the line who are talking to customers, and this topic is going to be fairly new for many of them. Perhaps they've never even spent the time to research or discover if any of their parts might fit something like this. What are some of the things that they could look for to even determine whether or not they should inquire with a FreeForm or somebody like yourselves?
Yeah, certainly. I think the biggest or the most easy thing to identify is complexity. If you have a part that you can look at a drawing and you only need two-dimensional views to manufacture that part, there's probably a better technology to make the part. Which when you get into a product that has an isometric view, or you have holes at angles, or you have interconnected internal plumbing or geometries, that's when you start to get into ideally an additive part. Another good thing is if you have multiple setups in CNC, or you have 4 or more axes CNC machining. Things that are just XYZ, there's probably an easier, cheaper way to manufacture it. And we're never going to beat the cost of something that simple with our process.
Hey,
Follow-up question
Chris,
for you. Oh, go ahead, Mike.
A follow-up to that, can you combine traditional manufactured parts with additive manufactured parts, right? So that are they complementary or is it kind of one or the other?
No, we have parts today that we print a part and then our customer welds them to another part or assembles them with a traditional fastener, things like that. And honestly, a lot of times those are good wins for us, because if I know that up front, I can go to the customer and say, well, why don't we just combine them in printing, and you can remove that assembly operation from your step, and now we can kind of reduce your bill of materials. That becomes kind of a cost savings for people as well.
Question on mine. So in terms of this machine that it's the metal binder jet machine, does one size fits all with regards to these machines? Once you get one in, they can do everything, or does it depend on the project, the type of machine you're ultimately using? I don't know the scope of how differentiated these machines can be.
Yeah, certainly. So we have 5 different machines. We have 5 machines. 3 of them are identical to each other, and then 2 are different. We have 3 that are more production machines. They have bigger build boxes, so we can fit more parts inside the envelope. But they are limited in materials that they can produce because of the types of powders that they use. And then we have some smaller machines that are more lab or development type machines. And we're using those to develop process and develop materials so we can get into different materials long-term for our customers. So the production machines we have today, you'll see down below there that we're limited to 17.4, 316, cobalt, chrome, and Inconel for some of our higher end materials from a production standpoint. But material development, we've done S7, we've done 4130, 4140, 8620, nickel-free stainless, 15. I could go on. We've done a lot of material development for both ourselves, for the powder companies, and for end users that want to develop technology for their products.
Excellent.
And Chris, I feel like we're attacking you on the slide, so I apologize. But just to clarify, there's 2, if I'm hearing right, there's 2 methods to go about additive manufacturing. It's either metal binder jet or metal injection molding. You can either do that in-house or you can work with someone like yourself. Is that correct? And you use metal binder jet.
Yeah, so metal injection molding is not an additive technology. It's more of a traditional injection molding technology. It's just another technology that we offer here at FreeForm. And if you're using MIM components today, metal injection molded components today, they might be a fit for metal binder jet if volumes are lower or you want to add complexity or things like that. So I kind of talk about these in tandem because they complement each other very well. And we offer both of them, and they need some of the downstream processes like sintering, which is a big investment. So it's a good complement to offer both.
Great.
Yeah, and I think that's a great point, because it could be, you don't just dive straight into metal binder jet or additive manufacturing. Maybe it's a segue of picking out certain parts within metal injection molding that you say are more applicable or better fits for
Yeah, I'll tell a quick story. You know, when we first got started, we had a customer come to us and they wanted 5 parts. And so we printed them 5 parts, they got them in their hands, and they said, you know, yeah, these are good, but we want to change a few things. So we made a few changes. They wanted to print 50 pieces. Okay, printed 50. They're like, this is great. Let's market test this. Let's buy 500 and we'll put them in the hands of our users. They got those 500 and they were like, okay, we want 50,000 of these a month.
Oh, wow.
And I was like, well, I can't print. I mean, there's just not a technology today to print 50,000 pieces a month. So it's not a thing. So we had to at that time to build a metal injection molding tool and launch a MIM process for that customer. But it's the perfect segue, and Mike will show it at the end there with that bell curve. It's like, now we can, with additive, we can serve your first idea of a part, and then at the top of your ramp peak decline, you know, your peak volumes, we can offer MIM. And then when we get to the backside of obsolescence, now we have a validated additive process. We can go back to that without increasing costs or setup times, things like that.
Great.
From a commodities perspective, our main commodity is metal powder. We buy a special cut of metal powder that is produced by a process called atomizing, which they take molten metal and they use gas or water to make it into metal particles. We use, if you do research, you'll see about like conventional powder metal that's more popcorn shaped. We use spherical, almost perfectly spherical powder. So it's pretty expensive powder, and it's made with a special process. And pre-COVID to today, we have seen some pretty dramatic price increases on our raw material, 36% on the 17.4 and 28% on the 316. We've been fortunate from a FreeForm perspective because we do buy pretty significant quantities. So we have not seen that type of increase from our vendor, but that's what they're seeing. We're able to put in blanket orders and kind of lock in pricing for a long time.
So Chris, just kind of taking a full circle, is it possible that the circle of life could be, you know, either Ryerson or one of our customers, if they cut off a small piece of 316 stainless, somebody eventually buys that in a scrapyard or at one of these powder manufacturers, they melt it down, molten 316, blow some argon gas or some sort of gas into it, and then that becomes your raw material?
That's exactly what happens. I mean, metal is the most recyclable material that we have in the universe. And that's exactly what's happening. So, you know, we're not buying, you know, old refrigerators or things like that, but, you know, pure scrap that's coming from a bit like a service provider, machine shop, you know, distributor like you guys. That's exactly where it's going. It's going back to the mill and it's getting atomized into powders.
It's a beautiful thing.
So these are some products today manufactured by FreeForm in our 3 main industries. We work outside these industries, but I think that these are the most have the most product examples: medical, defense, and industrial applications. We're seeing a dramatic increase in industrial applications, mostly what I would describe as valves and controls. Anything that's moving a media, whether that media is water or gas, and you want to put it in a specific direction. Additive manufacturing is a good way to do that because you can now manufacture internal plumbing and geometries that you can't traditionally machine with another technology. So we're seeing that grow pretty fast, and we're able to, you know, our technology is growing. We're going to make larger parts, which is good for that as well. Medical is great because these products would usually go to MIM or investment casting. But the medical life cycle is really long. You know, it can be years from the time you make the first part till your time you're actually at production. So having medical customers not locked into hard tool costs allows them to develop product faster and more cost effective and get it to market quicker. And then defense that's a pretty traditional investment casting and MIM rich industry. So there's a lot of product development, prototyping that goes on in that market. So we're able to do that quickly for them and then ramp up into production fairly quickly.
Chris, I like the slide because I mean, what you've always long characterized. If I look at these things, I can pick up any of these things and fit them in the palm of my hand, and that's kind of the adage, right? Is like the if it's a fit for additive, it's what, the size of a softball, you say?
Yeah, I think, I just had this conversation the other day. If you would have asked me 2 years ago, I would have said a golf ball. And then last year I would have said a baseball. And then today I'm very comfortable telling you a softball. With the
12
tools
inch
that
or
we have.
16 inch?
What's that?
12 inch or 16 inch?
Yeah. Yeah, I mean, with the tools that we have today, both quality tools and scanning tools and simulation software, I mean, the technology is advancing day over day. It's not stagnant by any stretch of the imagination. I don't know how much larger we can go because the material gets expensive. It's that's more for the customer to decide than me. But we are getting more and more, we are more and more successful every day with larger parts. Yeah, this is that curve I was talking about between our two processes of additive and metal binder or metal injection molding. We can now support the first idea you have for a product, the first form, fit, and function. We can service your millions of parts annually. And then when you get out of that phase out and obsolescence, now we have validated processes to serve, all stretches of volumes for your products.
Excellent. And maybe I'm putting Mike and Chris on the spot here with this question, but if we do have customers, we have salespeople who have an inquiry and they want to access FreeForm technologies. Like I said, they're not a company of Ryerson. How would we recommend that route go? What's that ideal path for how a customer might want to approach?
It's a good question. We have an email address set up, additive@ryerson.com, if you want to send your inquiries, and we'll make sure we get it filtered to Chris. That's additive, ADDITIVE @ryerson.com.
Thanks for that spelling, Mike.
It was tricky too. We got a few questions rolling in. I figured it'd be a good time to tackle some of those. Chris, do you think that additive is a good replacement for castings or forgings?
Replacements, that's a hard question to answer, because if we're looking at it from just a traditional dollar for dollar standpoint, it's not always going to be better. Actually, I would say most times it's not going to be better dollar for dollar. We have to solve a problem, whether that's a supply chain problem or a bill of materials problem, or reducing a machining step. We need to be able to look at the total cost of ownership of that part, not just, it's not really apples to apples all the time, but those are two technologies where we see our material properties are a fit for replacement.
Yeah. And then you had mentioned material earlier on, like 316, 17.4. How about a carbon steel equivalent, like A36?
I'd have to look at the chemical composition of the materials we have done, but carbon steels that we have done today would be 4140, 4130, and 8620. So I would think that between those three, there's got to be a correlation for what that customer is looking for, or that person's looking for.
Okay. Cost effectiveness. How cost effective is metal binder jet / MIM versus traditional milling machine work? Are these metal powders as available as traditional raw material?
Our raw material availability is good. We have not had any issues getting raw material. We issue blanket orders to our vendors regularly, so we have enough in the pipeline to get cost effective process for process. If it's traditional, like 3-axis milling, that's probably still going to be cheaper. But if you have 4-axis or 5-axis machining, that's where we start to add some bang for the buck.
Gotcha. You might have mentioned this. Can aluminum parts be made in this way?
Not yet. There's a lot of development. I shouldn't say not yet. It is possible, but not commercially possible. There's a lot of development happening in that space. If you do some research on Desktop Metal or X1, they have some excellent materials out there about where they're at with the development. Those are the makers of the equipment. They make the printing equipment. And there's a lot of interest in automotive and other industries about that material. It's just, there's a very narrow window of sintering temperature for aluminum. So there's an art to that process as much as there is an engineering aspect to it as well. So that is coming, but no, I could not make aluminum parts today.
And Chris, you're getting a flood of questions here. I'm going to give you one more before we move on to Nick, and we'll make sure we filter the rest of these. So, I mean, we obviously a lot of interest in this, but this is a QA one. Are you able to provide a certificate of analysis after material is molded or formed?
Yes. Yeah. So we get a cert from our vendor when we buy materials, and then we can also do chemical composition prior to shipment if that's desired for the customer. We have access to a lab here locally that we do that through as requested, so that's not a problem.
Great. All right, we'll hold the rest.
Yeah, I know we ran probably a little longer with our special guest this week than maybe we normally do, but I think it's worthwhile and it's important to do so because this is a topic that's so different and so tangential within the manufacturing space than what we normally talk about. So we appreciate Chris's time for joining us on this, and he's going to stick around till the end to take additional questions to the extent there are any. But no, Chris, that's great information. Really, really good stuff.
Thanks.
So we're going to hop into the macro side of things. And coincidentally, this morning I opened up my email, and normally I don't like sharing, external research because I think we internally at Ryerson have all the best research. But it struck me because it was an article or a research piece from Goldman Sachs, and I don't really want to pick a bone with or pick another legal battle with a bank, but I'm not sure who trademarked the revenge of the old economy, but Goldman's riding this train. This idea of the revenge of the old economy, they're kind of reiterating their stance on it. And the note literally came out this morning. If you look down in the bottom left corner, if you've joined us on prior Cup of Joes, this chart might look somewhat familiar or, related to one of the topics we discussed probably 6-8 months ago, which was sort of the old economy, how it's been performing relative to kind of the more pretty high-tech, high-flying equities and industries over the last couple of years. And they're kind of doing a very similar analysis here, actually charting out the performance of what they're calling the old economy. The old economy would be things like IBM. It would be things like ExxonMobil. It would be traditional banks. Things in the new economy would be things like Beyond Meat, financial technology companies, renewable energy companies. And what they've kind of acknowledged is the fact that there does look like there's a little bit of a reversion or mean reversion that's taking place, whereby some of those high-flying, very innovative companies like Apple, Google, Metaverse, they're pretty quickly coming back down to earth, while the old school economy, which is things that I think were kind of written off over the last couple of years, things like fossil fuels, things like metals, they're having a little bit of a relative resurgence. Now they mention it here in the chart that this is really more of a function of the high flyers coming back down to earth than it is the old economy going up. But I think they would argue within the broader note, and I would argue the same, that I think there's probably even some room for convergence from the old economy to continue to lift higher. If you look at the right-hand chart, just anecdotal, this is looking at a very old school company like ExxonMobil, comparing their earnings to a company like Microsoft. And for the first time in the last 4 or 5 years, ExxonMobil's earnings are now exceeding Microsoft's. So is that a little bit of an indication of maybe we've undervalued some of these old economies, like metals, like manufacturing, like energy, and maybe overvalued some of those high-flying technology startup type companies? Perhaps. We've certainly noted this on prior Cup of Joes, and it does look as though it's playing out anecdotally over the last, I'd say, 12 months, and may perhaps even continue as we roll through time. But I thought it was very interesting that Goldman was kind of echoing what we've talked about in the past.
Yeah, absolutely. And you shared this prior. We had a little bit of conversation about this. One thing I saw in there, it was kind of a note, really interesting. They kind of looked at it in stages. They said we're kind of entering this second stage where they said rising prices are constraining consumer incomes and discretionary purchases. And then we talked a little bit last week about Amazon coming out with their earnings. And is that kind of an indicator that, could it be an indicator of that consumer sentiment coming down, discretionary? Could Amazon be a good barometer of that?
I think it certainly could for a variety of reasons. One is Amazon's an absolutely massive company. They employ millions of people. They distribute products to billions of people. So I do think they're a barometer of that. Where I think that warning sign maybe comes in is the sense that for the last year or two, the pockets of individual consumers have been pretty flush. And you could probably even make the argument at the corporate level that so much money was printed, so much money was distributed out coming out of COVID, that people were feeling pretty good. People were feeling like they had a lot of, cash and liquidity to buy things and travel places. I think some of that's still occurring. I think people are still traveling, people are still spending money. But my concern on all this that we're transitioning into is maybe that spending is less so occurring with cash that's in their bank accounts and maybe more so happening with credit cards. So people are building up more credit card debt, taking on a little more leverage to do that spending. Or as the note suggested, maybe they're finally starting to say, maybe I shouldn't buy that next incremental product because maybe its price has gone up too much. And yeah, sure, maybe our wages have gone up by a little bit, but they haven't quite kept pace with the price increases we're seeing of goods and services. So yeah, I think that process is beginning to bite a bit. Now we'll get into a couple charts and a couple details that'll dive into that in a little more detail. But I will readily admit that I think some of that is purposeful. I think some of this intent of trying to get people to spend a little less money, feel a little less positive, I think I know it sounds perverse, but I think it's part of the goal of the Federal Reserve right now to try and cool things off.
Makes sense.
We always look at this chart. I really like this one because I think it tells a really nice geopolitical story. I think it tells you can kind of visually see the evolution of how manufacturing economies are developing over time. Again, if this is new to you, left to right, we're going November 2021 through October 2022. Top to bottom, we're working alphabetical order. So no real rhyme or reason other than that. But you can very easily see that over the last 12 months, we've seen a big green wave transition into a lot of yellow, and then we're seeing a whole lot more red. And there's no doubt about it. When we look at manufacturing PMIs, which is the purchasing managers indices for all of these regions, we're certainly seeing a softening. In certain regions, that softening is getting a little more severe. I think I would probably mostly point out the European region as being a fairly large area of concern. You see a lot more red within Germany, France, the Eurozone broadly. But outside of that, even, you're seeing a lot more yellow, and you're seeing yellow within the United States now as well, which means we're still seeing growth, but it's weakening growth. So the pace of that is declining. We're not yet in negative territory in terms of year-over-year growth, but it's certainly headed that direction. And if we end up following the path that a lot of these other regions have been on, it may just be a matter of time until we head into a little bit of softening. But on a relative basis, I still make the argument that the United States manufacturing sector is a bright spot on a relative basis to other economies like technology or other emerging market economies or the Eurozone. Similarly, I would say echoing that data, looking at the leading economic indicator index, which is compiled by the conference board, the same group of people that does the consumer confidence index. What we're looking at here is going to be the white line, which is the year-over-year index. The blue line is going to be the trailing 6-month index. Obviously, the trailing 6 months, if they've been worse than the prior 12 months, it's going to be a more negative indicator. And that's what we're seeing right now, which is basically suggesting that things are getting incrementally weaker relative to the last year. Within this index, it's 10 data points. So it's looking at things like the ISM manufacturing index. It's looking at both manufacturing and non-manufacturing data. So it's looking at jobs data, ISM services, and things like that. But no doubt, if we look at this cycle and where we are today at negative 5.6 on the 6-month index, and we look at where prior recessionary cycles occurred, it certainly looks as though if we're not in it, we're pretty close to recessionary type conditions on a broad US economy basis. That doesn't have to necessarily mean the manufacturing economy, but on a very broad basis, it does look like things are slowing down. So it kind of echoes the prior table that we were looking at. And as I mentioned earlier, I think a lot of that softening is purposeful. I know that sounds perverse, but I do believe that one of the efforts to bring down inflation and the rampant cost increases that we've seen over the last 2 years is to make people feel a little less wealthy. So whether that's stock markets coming down, whether that's housing prices coming down, or just potentially having people experience layoffs at certain certain companies, which is not a fun thing to talk about. And it is, I will admit, it's a bit perverse that anybody, you know, in a high ranking position would want that. But the goal is ultimately that if we're going to bring down inflation, there might be a little bit of pain. And that's the unfortunate truth, or the unfortunate side effect of this. What we're looking at here in this table or this chart is the 2-year treasury. So that's a freely traded instrument, to your government treasury yield. And then the blue line is going to be the Fed funds interest rate. So when you hear Jay Powell on the TV talking about whether or not he wants to hike interest rates or how much he wants to hike interest rates by, that's basically the representative index that he's referring to. So it's sitting right now, as of yesterday, they hiked by 75 basis points. It's currently sitting at 4%, which is much higher than where we would have been about a year ago, as you can see in this chart. But it's still not quite up to the level of the 2-year treasury. If you look over prior cycles, you can see that there is a little bit of an indication that the 2-year treasury yield tends to be a leading indicator for rising interest rates by the Fed and also falling interest rates by the Fed. So we haven't yet seen the 2-year treasury roll over and head lower and really signal the potential for that recession. It may be around the corner, but for now, it looks like we're still in a cycle of the Federal Reserve is going to continue hiking interest rates. They may slow that pace a little bit. And I think that's really the $1 trillion question at the moment is, when do they start to slow that? Because there probably is getting to be the point where we're seeing a little bit of economic pain. We'll talk about a couple charts here in a sec. One place where we are not seeing economic pain yet, and I think this is a little bit of a mixed signal, because I think in some ways it's a good thing, some ways it's a bad thing. Looking at the jobs market right now, this is one of the things that, it's one of the reasons why I still have long hair, to be honest, because the NBER, the National Bureau of Economic Research, they keep saying, well, we can't be in a recession when the jobs market is as hot as it is. And one of the things they're referencing is over on the left-hand side, which is we currently have 10.7 million jobs open that are not being filled right now. And you can see it very, very slightly on the far right-hand side. It was on the downtrend. We just got a new data point, I think last Wednesday or Thursday, and it ticked higher and it exceeded expectations by about 1 million people. So we have this phenomenon whereby it does seem like the economy is slowing, but for whatever reason, the number of jobs being posted is still extremely elevated and actually improved on a month-over-month basis. So that's one of the indicators that some of these economists are saying, well, we can't have a recession if the jobs market is so good. Well, what's interesting when you look on the right-hand side, this is the U.S. labor force participation rate. So what that's looking at is of 18 to 65-year-olds, those who are able to work, how many of them are, what percentage of them are working? And you can see that pretty obviously, right around early 2020, a pretty large swath of people decided they weren't going to work anymore, or they got fired because business conditions were so soft. But for whatever reason, about 3.5% worth of the working economy or working class people left for whatever reason the job market. So if you do quick math, if you say the working class is roughly half the population, you apply roughly 3% to that, that gets you at about 5 to 5.5 million people that left the workforce. And you can see that in the last 2 years, it's been a fairly slow trickle back for them to come off the sidelines. Referencing some of the things I said earlier, I do think there was a little bit of a phenomenon of people getting a lot of, I'll call it free money, or just, I don't know how else to say it besides handouts. Some handouts occurring. I think some people were doing trading on the sidelines. They were trading all the meme stocks and stuff. That may not have been large quantities, but I think some of that was occurring. And some people admittedly may have been fearful to go back to work for COVID reasons. But whatever the reason, it has been a slow trickle back for them to get back into the workforce. And you can see that even now, 2.5 years later, we still aren't back to the participation rate that we would have had pre-COVID. My personal stance is I actually think personally that people coming back into the workforce could be deflationary, not inflationary, that there could be a situation whereby supply chains can actually improve if more people are working, because the economy just works in a more efficient fashion. It works the way it used to work. Now, again, that's just Nick Webb's personal opinion, but I tend to not like for people, losing their jobs. I don't want to root for it. I don't want it to happen. And I will readily admit, I think within the manufacturing economy, many of the people on this call will probably argue there are a lot of job postings and a lot of job availability within our world, within this old economy, that is looking for people to find a home in. And it's happening to a degree. It's slow, but I think we're probably going to need a little more pain potentially of maybe people leaving the technology space and coming back over to, the bright side, which is metals, manufacturing, energy, things like that.
Well, it speaks well to our guests last month as part of the advanced processing nearshoring, bringing the supply chains back closer to home. And we're going to need more people working in the supply chain, obviously, for if that's going to ramp up. So
Absolutely.
Yeah.
Yeah, absolutely. I think that's certainly the case. And yeah, it's either going to mean that you need more people to fill those jobs, or you need more automation, one or the other. So certainly one of those two things, or a combination of the two. So unlike the jobs market, which is remaining relatively resilient, the housing market is pretty quickly coming back down to earth, and maybe even doing a little more than coming back down to earth, unfortunately. Mortgage rates over the last year, as the Federal Reserve has been hiking interest rates up to now 4%, mortgage rates have been doing much of the same. They've more than doubled. A year ago, they would have been 3% and change. The 30-year mortgage now is about 7%. So what does that mean? All things being equal, the cost of getting that home you wanted to get 6 months ago, it's going to be a whole lot more expensive. And maybe you have to downsize. Maybe you have to get a smaller home. Or if you're trying to sell your home, the price at which you sell your home is going to be a whole lot less than maybe what you wanted to sell it for 6 months ago or a year ago. It's a bit of a staggering move, because you can see this data is going all the way back to the 1980s. And we're basically looking at a home builder index that just in the last 2 years was the highest it's been in 35 years. And it's pretty quickly moving back down into territory that sort of resembles the mid 2000s through 2012, which was not a fun time for the housing market. So I'm not here to say that we're going to head into a housing crisis or anything like that, but I am going to say I do think in the coming months, you're going to hear a lot more about housing prices coming down, the housing market in general cooling off a bit, potentially even home builder construction cooling off a bit, just because it's getting a whole lot more expensive to get into a home or get into a car, because financing rates have gone up so quick. I think this is the next to last macro slide we've got. Pretty interesting scene within the freight side of things that I want to touch on. We've talked about the left index before in the past. We haven't talked about the right before. The left index is looking at the cost. It's the average cost globally of getting a 40-foot shipping container. So that's basically a shipping container to then toss on a barge. You can put steel and aluminum in it, ship it from China to the United States. Those rates, if you remember a year ago, they were going parabolic. There was essentially no price you could pay to get one of these shipping containers. They weren't in the right place. It was extremely difficult and very expensive to get them. Those rates are coming back down to earth in a very quick fashion. Some of that's centered around the improvement of supply chains, the improvements of supply chains. Some of that's centered around, slowing global trade, just the fact that as manufacturing is cooling off, getting a shipping container is just getting easier at this point. What's interesting, though, is if we look on the right-hand side, very, very different situation. It's almost even hard to see it because it's happened so quickly. And this is related to climate, for lack of a better phrase. The fact that we've had low rainfall here within North America, and specifically the United States, water levels in the Mississippi River are, I guess we can say, dangerously low. And because of that, what shippers are having to do if they're moving barges through the Mississippi River or through any of those networks, the amount of weight that you can put on a barge, given the lower water levels, is less. And so things are getting very expensive to move things by river right now, and that's all due to just low water levels. So pretty interesting phenomenon that's going on. I'm not sure if this is getting a ton of coverage, but it's certainly moved up by. Right now, the index is right around 9, let's say 88. Historical average over 10 years, $14. You're basically talking about, river shipping rates moving up by about 6 times relative to their historical norm. So pretty interesting phenomenon there. Last but not least, we've certainly spent over the last 6 to 9 months, a lot of time talking about the energy markets and the energy crisis, if you will. Maybe most poignantly within the European market, we've talked about the energy issues. I will be the first to admit some of the energy issues within Europe for now have actually cooled off a fair amount. They're still elevated. So to give you an idea, 6 months ago, the price of natural gas in Europe would have peaked out right around $90 per MMBTU. That's a British thermal unit. Right now, they're trading at about 30 to 35. So they've come down by, let's say, 2/3. Keep in mind, though, that $30 to $35 range, that compares to a US price of about $6 per MMBTU. So it's still very expensive relative to what we have in the US. But what's causing that is unseasonably warm weather. So maybe similar to what we just talked about on the rivers, Europe is seeing a warmer fall than expected. And I can tell you that's for now, even the climate activists potentially a bit of good news, because if they had cooler than expected weather, there were going to be some issues, and maybe there still will be some issues, but at least right now, as we sit here in early November, the warmer than expected weather is causing them to have to demand less energy consumption, which is allowing them to get through the early stages of winter a little bit better. That being said, what we're looking at here in this chart is the days of supply of diesel fuel in the United States, which I don't think we've talked a whole lot about this before, but in the last couple of days, the days of supply of diesel fuel in the US, which is a refined product of crude oil, for those who don't know, I apologize, is basically at the lowest level since 2008. So somewhat dangerously low, or certainly low relative to historical averages. Maybe what's more interesting about the diesel fuel market right now is it seems like we're running into situations where the diesel fuel is not getting to the places where it's being demanded. And what I mean by that is the northeast of the United States right now is experiencing some pretty extreme tightness and maybe even small shortages of diesel fuel. I don't want to get too deep in the woods here, but basically it's a function of lack of pipelines, lack of infrastructure, perhaps shipping related or Jones Act related, to get diesel fuel, which is being refined in certain parts of the United States, getting it to places where it's being demanded in more excess. So something to keep an eye on. It's an interesting phenomenon. So unfortunately, even though the United States has drained a couple 100 million barrels of crude oil, unfortunately, it's seeming like almost the issue isn't necessarily crude oil. It's getting that crude oil refined into something that's more utilized in a truck or a vehicle, which would be diesel fuel, gasoline, things like that. And admittedly, there have been a number of refineries that shut down during the COVID lockdowns, and many of them have not, or at least some of them have not come back online. So maybe we've got a little bit of a refining issue domestically or maybe even globally that's causing some of these issues.
Hey, Nick, before you move into the commodity side, we got a question here from the audience, which I think is a perfect bridge. The US dollar and commodity prices have appeared to be inversely correlated over the last couple of years. Is that by coincidence, or is that a general rule of thumb?
More of a general rule of thumb. I would say all things being equal, if you have a strengthening dollar, you're going to have it weighing on the price of commodities. And we're certainly seeing right now the phenomenon that the dollar has been extremely strong. The US has acted as markets have softened globally. The US tends to be a safe haven spot to put money. And when that happens, the dollar tends to strengthen. But what that also does is a stronger dollar makes it so that you can purchase imports for cheaper. You can travel abroad cheaper. So yeah, all things being equal, the US dollar is actually a converse indicator or an inverse indicator to the price of commodities. So up until this point, it has been a headwind. And as we get into the commodity charts, we'll certainly see that, which we can do now. So yeah, I mean, basically ever since we saw the Chinese lockdowns back in the reemergence of the Chinese lockdowns back in February, March of this year, combined with the fact that we've seen a very strong US dollar, we've seen really all commodities, but we're certainly seeing it here in this chart, which is aluminum prices. They've come off from about $1.85 all the way down to $1 a pound. We've started to find a little bit of a bottom, it seems, and we've talked about some of the reasons why in the past, and we'll talk about it again today. But we don't yet see the evidence that really suggests that prices are about to lift off just yet. A weaker dollar could do that. A China reopening or lifting its zero COVID policies could do that. It is worth noting that guess it was Monday of this week, so just a couple days ago, there were rumors that started to fly that China was contemplating lifting zero COVID policies. The rumors had, and the headlines had the commentary centered around March of 2023 as being that zero COVID lifting date. I think the reason why that date was significant at the time, or in the rumors, was that that's basically when the new CCP administration gets into, that's when they essentially get into office. Pretty quickly, however, within a couple hours, Chinese officials came out and said, there's no truth to those rumors. But what we saw along the way was, you don't see it a whole lot within these charts because we've just seen such large moves in aluminum over the last year. But there were some pretty significant moves in both LME aluminum and copper and nickel. Aluminum jumped up that day by probably 5% within a couple hours. Nickel, which I'll show you here in a second, jumped up by 10 to 12%. But when the rumors started to get dispelled by the CCP officers, things started to creep back lower. So again, until or unless we see a weaker currency, a weaker USD, or maybe some stimulative measure by China and a lifting of zero COVID policy, I don't think we yet have that real setup to see things lift off just yet. But that being said, one of the reasons why I think we're finding a little bit of stability in prices down around here is because of this chart, which says, and I apologize for those who've been on prior Cup of Joes, I just want to revisit this. Basically, what this chart is saying is roughly 50% of smelting capacity globally at current prices is uneconomic. They're not able to make that next incremental ton of ingot because energy prices are higher, labor prices are higher, whatever the cost of materials are is higher. So what happens when that occurs? Well, if you start digging into the marginal cost of production, some of these entities will start to shut down. And what you see is you'll see curtailments of supply. We've seen a little bit of that already within German markets, European markets more broadly, a little bit within China. But the deeper we go with an LME ingot price, the more of these smelters become at risk of closing. So I think that's why we're beginning to find a little bit of stability and a little bit of price support down in and around this area. I think it's really centered around this chart here. So keeping all of that in mind, if we do happen to see energy issues rear their ugly head again, natural gas prices in Europe double or triple, this chart becomes front of mind very much so again. And then on the Midwest premium side of things, despite the fact that we are seeing diesel fuel tightness, I will say that freight markets broadly, the ability to get a truck and get it to places is getting easier continually. And a lot of that centers around this notion that manufacturing markets are cooling both domestically and abroad. That tightness that was causing supply chain bottlenecks has, for the most part, eased. There is still a little bit of a looming risk of a rail strike. I still think clear heads will prevail around that, but it does exist. But as far as this chart is concerned, given the weakness in the freight markets from an availability of trucking standpoint, it does look as though the trend is likely to continue for now in Midwest premiums, which is lower for longer as we sit here today. Flipping over to the carbon side of things, we've looked at this chart many times in the past, but it's looking at US prices in the white for hot rolled coil relative to the blue line, which is North Europe, and the orange line, which is China. Certainly there's been convergence in the prices between US prices and foreign markets, and that probably adds a little bit of stability or causes prices to decline at a slower pace. But worth noting, you can see it very, very slightly down there in the bottom right corner, given the fact that Europe is having its own economic issues, given the fact that China still hasn't really reemerged fully from its zero COVID policies, they continue to creep lower. And what that ultimately does is, all things being equal, it resets the global price of steel lower and lower. So where do we find a home? Well, one of the metrics we tend to use, or I tend to use here at Ryerson, is, well, let's look at the cost of making steel within North America. Similar to that aluminum chart, it's kind of trying to back into, well, where do we start to get to a point where steel mills don't want to make anymore? Well, right now, what's interesting is, and I need to be very clear in this. This is not investment advice. This is not buy-side advice on steel, but it is worth noting that when you take the metric of scrap, which scrap is one of the main raw ingredients to an electric arc furnace, and you add on $300, which I'm estimating to be their margin to cover energy, labor, other alloying elements, and their own margin. If you take busheling scrap plus $300 and compare it to the current futures market, the US hot roll coil futures market is actually at a discount to that cost structure. So that's not necessarily we are at a bottom. It could mean we are nearing a bottom. It could mean we're getting into a fair value type process. But certainly we're digging into an area where I would guess behind the scenes at the steel mill level, they're starting to have conversations, or maybe they've been having conversations of what do we do to slow the decline? What do we do to better balance supply demand conditions and put a little bit of a floor in prices? What's interesting is I showed this chart last month, and when I showed the chart last month, I put in this trend line, which is the two white bars to basically show the trajectory to which capacity utilization at the steel mill level was trending, because that was ultimately the trend at the time. Fast forward a month later, you can see that very quickly, and maybe this is the steel mills having these discussions behind the scenes to say, stop the bleeding, start reining in production. And you can see that very quickly, production capacity utilization at steel mills is moving lower at a fairly rapid rate. So what does that mean? That means that they're trying to do their best to better balance supply demand conditions is how I read it. And so you take that into consideration in combination with the fact that scrap prices are beginning to stabilize a bit in and around these levels. Maybe we are going to begin to see a little bit of a troughing effect in the coming months in steel. Again, not buy-side advice. We're just trying to watch the indicators as closely as we can. But it is worth noting that the pace of these declines in production have sped up over the last 30 days. Talking about the steel plate side of things, it's amazing because I continue to think it's going to come materially lower in a fairly quick fashion. It continues to levitate. I was talking to my analyst about this just a couple hours ago, and he said, why in the world would steel plate be so much more elevated? It's at $1,000 premium roughly to hot roll coil. You make plate in basically the same way you make carbon sheet. And it is true, you do. All the raw ingredients that go into steel plate are basically the same as steel sheet. The difference is a couple fold. One is there's lower volume within plate. So perhaps the ability to have fewer players maybe controlling a larger piece of that market is possible. There is a possibility that certain end markets, maybe the infrastructure bill, some of these government funded projects are putting a little bit of a better bid into the plate market for construction, road repair, things like that. Some of those things are very valid. And maybe we do perhaps see this spread continue. I tend to think, though, again, clear heads prevail. This spread looks pretty exorbitant to me. If the raw materials to make both are mostly the same, I tend to think this arbitrage closes up, because unlike what we're seeing on the carbon sheet side, where steel mills may be reining in production capacity, every single plate mill and their brother should be making every bit of plate they can right now, because they can do so very, very profitably relative to making sheet at this time. Lastly, flipping over to the stainless side of things, I'm mostly going to spend time on nickel, which admittedly has been somewhat boring. I did mention earlier in the week that when the rumors came out about China lifting zero COVID, we did see a move higher, and you can see that very, very briefly down here in the bottom right corner. It moved higher by about 10 to 12%, which is a lot, but relative to the moves we've seen over the last year, it barely even shows up on the radar. So what we're really, I guess how I'd summarize the nickel market, it's interesting because you've really got a tale of two different types of nickels. You've got class 1 nickel, which is refined nickel. It's very high in purity. It is the grade of nickel that goes into the LME exchange warehouse system. That grade of nickel is very lean. It's tight. You can see here in the blue line, you can see the inventory changes. Well, the inventory in the blue line and the inventory changes on a month-over-month basis in the orange lines. Class 1 nickel is tight. There's no doubt about it. And that's one of the reasons why we saw the squeeze that we did earlier in the year. When you look at the right-hand side, though, and I think this is why we've seen a reemergence of this guy, this man they call the nickel tycoon in China. He has come back to the banks after the short squeeze that occurred 6 to 8 months ago, he's gone back to the banks and he said, I want to short more nickel. I want to hedge more nickel, protect my downside risk. The reason I think why he wants to do that is because he's looking at what's on the right-hand side, which is basically showing that there's an ever-growing gap between the price of refined nickel, which is class 1 nickel, and the price of secondary nickel, which would be nickel pig iron, nickel matte, and a lot of these secondary units. There's about a $5,000 per metric ton premium between those two right now, which is about $2.50. So my thought is this, the nickel tycoon, he's likely, because he's mining nickel pig iron and he knows how much he's mining and he knows that market is pretty well supplied. That's why he's wanting to sell or short class 1 nickel. The issue is class 2 nickel, which is nickel pig iron, nickel matte, things like that. That's not what's traded on the LME nickel exchange. So you've got this weird conundrum where what the nickel tycoon is wanting to hedge and the reasons why he's wanting to hedge it almost is irrespective of what actually happens on the London Metal Exchange, because they're really two different products. That being said, it is worth noting that many of these secondary nickels, nickel matte, nickel pig iron, they can be used to make the same things that refined nickel can make. So they can go into stainless steel production. They can go into lithium ion batteries for electric vehicles. So my thought, taking a step back, is on a broad nickel basis, it does look as though the market is fairly well supplied. There still may be some gamesmanship within the class 1 nickel market because inventories are so tight. And there may be even further dialogue around potentially banning Russian material on that exchange. We'll have to see. But with regards to just making stainless, accessing nickel units, it looks like the market is fairly well supplied as we sit here right now. And that's mainly because of the secondary market, not the class 1 market.
Yeah, Nick, has there been any update on the potential ban on the LME?
There hasn't. It's kind of come out of both sides of the industry's mouth. Some aluminum producers are coming out saying they're adamantly opposed to it. I think because they realize how reliant they are on Russian material. Worth noting, the largest smelter within Europe, who may have a little bit of a horse in the race, if you will. This is Norsk Hydro. They've come out and said that they support the banning of that, probably because their business would do quite well in that scenario. But there are very mixed reviews on it. I'll just leave it. I don't want to speculate too much on what way it goes, because it is really binary, and it's going to be a group of 10 or 15 people in a room determining how that goes. Sure. But yeah, it's still in limbo right now.
So we have about 2 minutes left, and we've got some questions here. I'm just going to go through a few. One that came in early on that I definitely want to get to. Nick, you talked earlier about the U.S. economy. Back to your PMI slide. What data really supports that the manufacturing sector is still a bright spot in the U.S. economy? What points are you looking at?
I mean, I think you could look at a number of different indices. I think when you compare, if you compare the ISM PMI, or in this case, the data provider is a company called Market. When you see a PMI that's sitting at 50.2, which is where the U.S. currently is, keep in mind, even though that's lower than where we had been, that's still suggestive of year-over-year growth. I'll just go back to the slide. If we instead look at the leading economic indicator index, which is looking at a more broad basket of economic indicators, it's actually already in negative territory. So I would say that if we're looking at a broad economy, it's incrementally softer than the manufacturing space in a silo, if that makes sense.
Yep, makes sense.
I think you could probably use, just to expand, I think you could probably use other metrics. You could look at equity prices, things like that over the last year. You could probably very easily see certain things like Facebook, Apple, Amazon, their price performance has gone a very different direction than industrials and energy companies and things like that.
Okay, makes sense. Hey, Chris, one back to you here, back to the additive manufacturing side. If you're looking at additive versus traditional, are you looking at something that could potentially help with reducing weight in your product, or helping with, they put shape complexity?
Yeah, we actually do a lot of weight saving exercises or lightweighting exercises with our customers, especially if they want to convert product from even titanium to stainless or aluminum to stainless. because the benefits of the material of stainless might be better than aluminum. So we do a lot of exercises like that. We actually have been able to make product lighter than those other lower density products with stainless.
Got it. Okay, perfect. Nick, back over to you. So why is steel bar so slow to come down? So we talked about plate and sheet. Is there, what are your thoughts on steel bar?
I don't have a great explanation on the plate side. I equally, I would say, don't have a great explanation on the bar side, except for the reasons why I gave, which would be their smaller niche markets, arguably commanded by a smaller number of players. Maybe they're able to hold their toes in the ground a little better, particularly in the face of infrastructure projects. So if I was going to cite one thing, I would just be the fact that money is flowing into the manufacturing economy in certain spots and certain industries, and perhaps the beneficiaries of that are more so plate and bar relative to sheet products. And I think additionally, one of the reasons why sheet products have seen incremental downside, perhaps relative to plate markets, bar markets, the automotive industry has continued to just struggle along. So that's one of the biggest, that is the biggest consumer of carbon sheet within the North American market. And if automotive is kind of, just struggling along, sheet market's going to follow that.
Yep. We're over time here. We have some more questions coming in, but we'll get those answered. We're going to follow up. Chris, I wanted to say thank you. This has been a topic that's a little different than what we've covered in past Cup of Joes, and by the gauge of the audience, it sparked a lot of interest. So thank you for joining. And I just want to say again that if you do have questions or anything you want us to pass along, the email address was shared in the chat. It's additive@ryerson.com. Nick, I'm going to give you final word as always. But Chris, I want you to give kind of a final word. But Nick, someone says Ohio State is going to lose on the 26th. I don't know who they're playing. So you need to get a mullet rather than shaving your head. So it's an interesting comment.
If Ohio State loses to Michigan, I might be willing to agree to a mullet for a couple days.
Great. All right. So reminder, the full recording is going to be available on YouTube. Also check out Metal 101. Join us next month. We're going to do something special for the year end. But before, Chris, any closing thoughts?
No, this was great. Thank you for having me. And hopefully as our technology progresses, we can come back on and talk about how our commodities of our process are more greatly affecting these other charts that Nick has put together here.
Thank you, Chris.
I have blabbered on way too long already. I'll just leave everybody with, if you've been watching all the slides that we just presented on, and you've been watching the Buckeyes throughout this football season, it looks like the odds of a recession are much higher than the Buckeyes winning a national championship. So I kid. But no, thank you everybody for your time. And we'll look forward to next month.
Thanks, everyone. Bye-bye.